Hey, what's up you guys, it's Kurt here, welcome to the channel. Today we're going to be talking all about asset allocation. And I don't know if you know this, but asset allocation is the single most important decision that you need to make as an investor because it has the biggest impact on your portfolio return. So I get asked by a lot of people, Kurt, what is the right asset allocation for me? Or Kurt, what is the right asset allocation for my portfolio? So in today's video, we're going to talk all about what is asset allocation and how that impacts our rate of return from our portfolio. Also, I'm going to give you some formulas and guidelines how to come up with the right asset allocation for yourself. And also make sure you stay until the end because I'm going to give you as a bonus sample simple portfolios which have the right asset mix in my opinion. So this is all we're going to be talking about today. Stay tuned. Alright, so what is an asset allocation? An asset allocation in layman's terms is nothing more but simply dividing your portfolio into categories or the so-called asset classes. And there's basically three main categories that you need to worry about as you try to come up with your asset allocation. Namely, that is, how much should you have in stocks or equities, how much you should have in bonds or fixed income, and how much you should have in cash. So the cash, that can be represented by certificates of deposit, your money market funds, or you may have literally some cash or different currencies, or you may have some crypto, but they all would represent your cash portion of your portfolio. So generally when people talk about what is the asset allocation of your portfolio, they typically mean what is the ratio of stocks versus bonds in your portfolio. And generally it's considered that holding more stocks is more risky and holding more bonds is more stabilizing of your portfolio. So in great market volatility, having more bonds, that basically reduces the volatility of a portfolio and you see less of a decline versus if you're holding 100% stocks, for example, in market downturns, in bear markets, you may see a drop of about 50%. So another important aspect to consider is the fact that this ratio of bonds versus stocks greatly determines the rate of return of your portfolio. This is because stocks have historically outperformed bonds by a great margin. So typically with stocks you can expect a rate of return of 7 or 8% if you're conservative, or maybe 10, 12, 14% or higher on a really good year. In contrast, with bonds you expect anywhere between 2 to 3%, and that simply matches inflation. This is why people are more eager to bet on stocks to give them higher rate of return, but this comes at the expense of higher risk. So having, for example, a 100% stock portfolio gives you a higher risk. So in market volatility or hard times such as recessions and big disastrous events, your portfolio may drop with up to 50%. And this is when it becomes really hard to stomach these downturns because most people get very emotional, it's very tough psychologically, and they cannot withstand the fact that their portfolio lost value of 50%. And they end up selling their stocks at probably the worst possible time. But let's take a look at what is the actual rate of return with the different percentages of stocks versus bonds. And before we dive into the numbers here, I want to highlight that the asset allocation is an important input to your investment policy statement, or in other words, your investment plan. If you don't have an investment policy statement, I recently made a video how to create one, so be sure to check that out. I'll link to it in the info card up in the right corner of this video. Alright, so let's take a look at the different allocation models or splits of bonds versus stocks and truly understand what is the implication of having the various allocation proportions. Vanguard does a really nice job in showing this visually, so I'll just use their site. By the way, I'll put the link to this in the description so you can take a look at this article later. To properly evaluate what is the long-term rate of return of these different asset allocations, Vanguard actually offers us data from 1926 to 2018. This includes all the bull markets and all the bear markets, all the recessions we've had up until 2018. So this is what we could expect as a rate of return if we're long-term investors. So let's take a look at the various asset allocations ranging from 100% bonds all the way down to if we were 100% in stocks. In other words, in a very risky portfolio. So if we had only bonds in our portfolio, or our portfolio consists of 100% bonds, our historical rate of return was 5.3%. Now, what happens to that portfolio if we try to add just a little bit of stocks? If we add only 20% of stocks and we reduce the bond portion to be 80%, then our annualized average rate of return was 6.6%. That is, for that little bit of stocks that we added, our rate of return increased with 1.3%. That's pretty significant. Now, if our portfolio was comprised of 30% stocks and 70% bonds, our average annual rate of return was 7.1%. And if we look at some of the more balanced, Vanguard calls them balanced asset allocations, for example, if we had 40% stocks and 60% bonds, our average annual return was 7.7%. And if we were 60% stocks, 40% bonds, we got 8.6%. That's quite a difference. So even though we're in the balanced asset allocation, we got significantly higher return than just having a 100% bond portfolio. And interestingly, what happens if we actually increase further the stock allocation? That is, if we aim for these, what Vanguard calls growth asset allocations, say 70% stocks or 80% stocks. If we have 70% stocks and 30% bonds in our portfolio, our average annual rate of return jumps to 9.1%. And if we're actually able to stomach this, if our portfolio is 100% in stocks, our rate of return was 10.1%. Now that's a significant difference compared to the 100% bond portfolio. Just to remind ourselves, the 100% in bonds gave us just 5.3%. So having a riskier portfolio with more stocks give us a significantly higher rate of return. This is why I say nailing down the asset allocation is probably going to be the most important decision that you need to make as an individual investor. It's going to have the highest impact on your rate of return. So what is the right asset allocation for you? It's a little bit difficult to give a generic answer because it differs from person to person, but I'm going to give you a couple of formulas that you can use as a guideline or use as a starting point to come up with your asset allocation. So typically a rule of thumb is to use your age as the percentage of bonds in your portfolio. Meaning if you're somebody that's 20 years old, you will be having 20% in bonds and 80% of stocks in your portfolio. Or if you're somebody that's 40, you will be 40% in bonds and 60% in stocks. Now there is a variation of that formula which is a little bit more aggressive, which states to have your age minus 10 as the percentage of bonds in your portfolio. So if we look at the same examples again, if you're 20 years old, you would be having 10% in bonds and 90% in stocks. If you're 40, you would be having 30% in bonds and 70% in stocks. Now, I really believe that the ultimate decision is not going to be your age, but basically how risk tolerant are you. If you're somebody that's very risk averse, you want to have some bonds, maybe a significant portion of bonds in your portfolio. If you're somebody that's very risk tolerant and you can weather market downturns, recessions, and things like that, then you're fine of having a higher percentage of stocks in your portfolio. So I think actually if you're risk tolerant and if you're somebody in your 20s, even in your early 30s, that you probably don't need any bonds in your portfolio. I would actually say that if you can stomach it, hold 100% in stocks or minimal amount of bonds really, because that's ultimately give you a higher return in the long run. So there are many portfolios you can look up on Google and you'll find they have some fancy names and clever names, but the reality is you don't need a complex portfolio. In fact, as a boglehead, I subscribe to the idea of a simple, broadly diversified portfolio. So you can take a look at the Vanguard Target Date funds, for example. A Vanguard Target Date fund is an all-in-one fund, which is basically a portfolio of bonds and stocks, and they're adjusted based on your age. So if you go to Vanguard and examine the different target retirement funds, say if you're somebody that's 20 years old, so you've got about 45 years to retire now. So if you look at that portfolio, it's basically adjusted based on your age, and at the moment, if you were to buy that target retirement fund, you'll be about 90% in stocks and 10% in bonds. So that's kind of like the formula of age minus 10. And as you age, as you get closer to retirement, Vanguard will automatically adjust the bonds portion. It will start increasing it for you. And another option is also to look at a simple 3-fund portfolio. This is what I really like, because you can basically have the Vanguard Total US Stock Market, you can have the Vanguard Total International Market, and you can have the Vanguard Total Bond Market, and that could be your portfolio. So you just need to decide what is going to be the asset allocation of US and international and how much you want in bonds. Say if you're somebody in your 20s and your 30s, probably about 20% in bonds is enough. So you just need to figure out the split of US versus international. And you may also even not have international. So your portfolio may be as simple as just having 2 funds. One, which is the total US stock market. That could be, say, 80% of your portfolio, and then 20% of your portfolio to be the total bond market. And that will be sufficient. And as a matter of fact, having that portfolio, most likely you will do better than most of the investors out there. Thanks very much for watching, guys. I hope you have a wonderful day. If you liked this video and you found it helpful, make sure to destroy the like button, because that's the only way to let other people know about the video. And if you're new to the channel, make sure to subscribe for more videos on investing, personal finance, and crypto, and hit the bell notification icon so you never miss a new video. Until next time, stay the course.